Hi, everybody, and thanks for joining. I want to get started by introducing our guest today, David Frankel. So David is a Senior Vice President of Mortgage Lending at Guaranteed Rate. How's it going, Dave?
It is going great. Another great day in the mortgage industry. Lots of interesting stuff happening lately.
Awesome. Well, I'm really excited to talk to you about all of that. Thanks so much for being here.
You're welcome.
I thought that it would be best maybe if we role played a little bit. And I will be a buyer who is relocating to the mainline area. And you will be the local lender here in the Philadelphia area who helps people with this process.
Great.
So I'm going to ask you some questions from the buyer's perspective, and we'll pretend that I have no idea what I'm talking about. Does that sound good?
Yeah, let's answer those questions so that people in a similar scenario will be comfortable.
Okay, awesome. So now that you know that I'm someone relocating to the main line from another area, and that may be Center City, Philadelphia, or it may be another state, what information are you going to give me up front to help me understand the mortgage process in Pennsylvania?
I'm going to start with asking you if you have purchased before or taken out mortgage financing and how recently. So that's to judge frame of reference and see when the last time you went through it and compare it with now in broad strokes, because a lot of what we'll do is going to be uniform nationally. I'm licensed in 13 states, so pretty straightforward to cover the majority of things, honestly. So we would start there. And then the big thing to really think about is just preparing people for, there are a couple big things. First of all, on the main line, how taxes are billed and paid and collected. Let's start there. Most townships there, you'll have a municipal tax, you'll have a county tax, and you'll have a school tax. And when we give you that information, it's all going to be one monthly tax payment that, if you have an escrow account, will be collected and paid out when it's due. But the initial conversation and initial estimates, you're going to see 3 different tax bills, and you're going to wonder why. And we'll talk about that, and we'll be able to compare. And as you were talking with Siobhan, as a realtor talking with you about the different communities and the different school districts, you'll see the difference in some of those tax bills from one to the next. Second, we're going to talk about how to, when they're paid, not just what's paid, but when they're paid. They're paid separately. They're one bill paid in the spring for municipal and county, one bill paid in the fall. And reminder people that you as a buyer, the taxes here are paid forward. A lot of places they're paid in arrears. So you might come to settlement and the person whose home you're buying would give you a credit because you'll be paying taxes from the time that they lived here, but here they're paid forward. So you will likely end up reimbursing a seller for taxes already paid for time that they won't live there. Another big thing to be prepared for. Are you seated? Good. We want you to be seated. Closing costs here are generally higher than they are in most other places where I work. If you're buying on the main line, 3.5–4% of your purchase price, which is higher than a lot of places. That's a combination of transfer tax, which is sales tax on real houses, title fees regulated by the state of Pennsylvania, but important. And you'll generally end up paying about 1 full year each of insurance and property taxes. So I just want people to be prepared for that. So when they tell me they've got enough for 10% down or 20% down, we want to determine if that's total or if that's what you're putting down plus your closing costs, which, as we noted, something to be prepared for.
Okay, awesome. Other than the taxes and the closing costs, are there any other particular challenges from your perspective as the lender when people are moving to the main line?
Nothing specific to properties here. We go through the usual and we'll review income, debt, credit, and assets just as we would from elsewhere. But no, otherwise it's pretty straightforward. We would use a local appraiser to establish a value for the property. We'll underwrite based on the loan criteria and borrower criteria. Other than that, there's really nothing super unusual about it.
Okay, great. So Dave, if I'm moving to the main line because I'm going to be starting a new job, so I'm relocating here, can I buy a house using a mortgage before I start that new job? And if so, how does that work?
Yeah, first of all, congratulations. That's great news and welcome. Very nuanced answer, as it is with a lot of things related to the mortgage industry. And the most thorough answer is to say it depends. And in a little more detail, pretty likely that you can. Most of our loan products allow for future employment and future income. And what depends is how that income is structured and how your agreement is structured. Most of the time, if you are coming, like we have a lot, right? Philly's known for eds and meds. All the universities, all the hospitals, major insurance company. We get a lot of those people, a lot of employees coming here to work in one of those fields. And when they do, they'll come with an employment contract. And employment contracts, meaning offer letter, right? Contract, it may imply a closed period of time, a finite period of time, but an offer letter that says, Siobhan, we are pleased to offer you the position of superstar realtor, and you are coming to Pennsylvania Magic Land Corporation and starting on this date for permanent full-time employment with this salary. And those are the main things we look at. It has to be permanent, open-ended employment. So when I said contract, I didn't mean contract. It has to be an offer letter. So open-ended, no end date, permanent, full-time, and it has to have a salary, right? If it's hourly, we have a harder time and we will likely need a pay stub before we can close. But if it's salary, we can take the base salary. If you're dependent on things like a bonus or commissions, that's going to be a challenge to count that. But with those criteria in place, and it has to be non-contingent as well. That's another big detail. We can't say, we have something here and it's contingent upon you doing X, Y, and Z in the first 30 days of your employment. That's not certain and predictable. And those are important words for underwriting mortgages. And then with that, most of the time, as long as you start within 90 days of your settlement, the closing date of your purchase here, we're good. We may have some loan products that require a 60-day window to start, but nothing shorter than that. And very often it's up to 90 days out. So we have a lot of people who will come for the universities and will start teaching in September and want to get here late summer at least to get settled. So they don't have to be in temporary housing or something. And that's something definitely we want to work with you on that.
Okay, great. That's very good to know. Okay, so Dave, if I'm moving to the main line and I'm trying to figure out what to do with my current house, as in, should I sell it right now, or maybe I should rent it out? How does that decision play into my ability to get a mortgage for a new house?
Yeah, another good question. So when we're looking at qualifying you for financing the house here on the main line, we would look at first, what do you owe on the house and what's your monthly obligation? So principal, interest, taxes, and insurance if you have a mortgage, HOA fee, if any. And even if there's no mortgage, we still have to look at taxes, insurance, and any HOA fee. And those get counted as just another debt, like as if it were a very large car payment or student loan payment or something else. And so if that works, if you don't want to have anything in your purchase contract here contingent upon disposition of your other property, and you have sufficient income to qualify with both payments, we can go right ahead. There may be a requirement. I guess, again, it will depend on the loan product that you're in. You may have to have extra reserves. That we may need to see that you have 3 months worth of payments on both houses, or 6 months, worth of payments on both houses, just because you're going to have 2 payments. So you'd have to have some cash reserves, but no reason not to keep it. If you're coming from a distance away. One caveat there: if you have current FHA financing and you're moving less than 100 miles and you need to take out new FHA financing, can't do that. FHA has a distance requirement that conventional investors do not. And if you got questions, we can talk more about that. Next piece, if you don't qualify with both payments, if you want to keep it as a rental, almost all of our loan products, if you have a 12-month lease in place and you've collected deposits, it can start after you move out. It doesn't have to start now. We can count that rent towards offsetting the payment. there's a formula we have to follow to allow for vacancy and underwriting guidelines, but we can count that because that's going to be your income. And if you sell it, right, if you sell it and it's done and gone, then it's gone. And if it's sold before you close here, then it's gone. And your proceeds from selling are assets immediately. There's no seasoning. Or if you're selling and you don't need the assets, but you have it under agreement, somebody's purchasing it, and that person has provided you as the seller with the mortgage commitment for them to buy, you can, in very many cases, actually exclude the payment from your debt because it is contingent for sale. So there are a number of ways to go through it. There's no one hard and fast, but a lot of it is really about what your income and debt to income numbers look like relative to the new house and how much wiggle room you have with a second payment.
So if I'm going to long-term that house, how much of the anticipated rental income can be used to help me qualify the next mortgage? Is it 100% or is it a partial?
75.
Okay, so 75%, let's say that I have a lease signed for $1,000 a month. I can consider $700 a month part of my income now.
Yeah. Towards offsetting the payment.
Okay, and what if I don't have a 12-month lease? Let's say that I'm coming from an area that allows short-term or a medium-term rental. A medium-term rental might be like 3 months, something like that. Can I use anticipated income from a short-term or medium-term rental to help me qualify for a mortgage?
Medium term, no. And it really, in this case, would depend what you could do on short-term income. It's often allowed on a purchase. It's becoming more prevalent depending on where you are and what sort of data there is for short-term rental potential.
Okay.
But that would be on a case by case. We would want to talk about what's there and what's your plan. And do you have a history of renting it out? Do you go somewhere for the summers and have experience and numbers? And are you coming from, I don't know, Southern California where people would want to do short-term rentals? Are you coming from Northern Arizona where people would want to get out of the heat in the summer and do weekly rentals in the summer? What's the market like? But that's one of those that's a real maybe.
Okay. And then I'm moving to the main line and my current house, I've decided I'm going to sell it. What is the difference between I'm going to sell it, but I haven't listed it yet? I've listed it and it's under contract, but with contingencies, and I've listed it, it's under contract, and we are past the contingencies. And for anyone who is confused about that, a contingency is something like an inspection, an appraisal, or a mortgage that says that the buyer can back out of this contract based on this contingency. So if for some reason the house doesn't appraise or the inspection doesn't go well, the buyer can still get out. But there's a period in time where we pass all those contingencies and now we're just waiting to close. So what is the difference between I haven't listed it yet, I've listed it, it has a contract with contingencies, and third, we are past all contingencies?
Yeah, so the first two, not having listed it yet and being under contract, but with contingencies and without a mortgage commitment, you have to qualify with the full payment on the old house and the new house.
Okay.
The third option, if you're just waiting to close, I said in almost all cases, that may be a bit of an exaggeration. In many cases, with a mortgage commitment for the buyers of the property you are selling, we can exclude that payment. So if your debt to income is too high, counting both payments, and then you have a mortgage commitment in hand, even if it doesn't close, we can exclude that and presumably get your debt to income numbers to where they need to be to close on a new purchase.
Okay. And in terms of the down payment, I can't really use that money to make, if I say I'm getting, let's say 100,000 out of this other house, that's what I'm going to net once I sell it. Can I use that 100,000 on the down payment on the next, or can I only do that if I've already sold the first one? Like sold meaning it's closed, the check was cut, it's in my bank account.
Yeah, so certainly that's easier. And it doesn't even have to go to your bank account. We do lots of back-to-back selling and buying, sometimes even same day, but almost the next day is easy. Your proceeds can travel via wire. You don't have to have a check. We don't need to see it. I mentioned before, there's no seasoning period. It doesn't have to be in your account for anything. It can go from the settlement agent where you are selling to the settlement agent where you are buying straight away. And we have the settlement sheet from your sale and receipt of funds for your purchase immediately available, your funds. If it hasn't sold, how do you tap that equity to be able to use it for your purchase? The main option really would be a bridge loan. And that is, it's a bridge from house A to house B. We offer them in the states where I'm licensed. And sometimes there are options with local community banks, is often what it is as well, where you can borrow based on the equity you have in your house, and it fills the gap between what you owe and some percentage of the appraised value, often up to 80%. And it's usually a balloon with the understanding you're going to sell and you have to pay it off when your house is sold. So that's another way to do it. Borrow, pay it back. Like any loan, it's not without risk, but it's a pretty good bet if you're in a good market. That's a way to free up capital. It's also another way, potentially, if you have family, you can't borrow from family. Gift funds are one way to do it. You can't just borrow an unsecured funds. Mm-hmm. But if the family want to issue you a bridge loan, it's secured by your house, it would be the same idea. That's something we could discuss too. Family would take an interest in the house and they would get repaid when it gets sold. Something else to put out there if you've got some people who may have the means and the inclination to help with something like that.
Okay, so that I'm glad we got into that, because that was actually one of my questions, which is, if I'm moving to be closer to my family and my parents want to help me buy a house for whatever reason, because I'm having a baby, because I'm going to help take care of them, my parents, whatever it is. Mm-hmm. How much does it matter to you, my lender, where my down payment comes from?
100% it matters. That is the most black and white statement we can make. There is no gray area. All of your funds matter to us, and we need to document them. Okay. If they come from parents versus your own account, that's where we get into some gray. And another one of those things, it's going to depend on the loan product. Conventional conforming loans for purchase of a primary residence, 100% of the funds for down payment and closing may come as gift funds from an eligible relative. FHA, the same. When we get into our conventional jumbo, so higher loan amounts above what Fannie Mae and Freddie Mac will accept for their conforming limit, that's where we get into we just want to be careful. Some of our jumbo loan products require a buyer to make the first 5% or 10% from their own funds before they accept gift funds. I don't know many other than an investment property where you can't use them at all. We just have to be careful and make sure that if it's all coming from a gift, we get you into a loan that allows for 100% of your funds to come from a gift. And we document it. There's a gift letter signed by the donors and the recipients stating that this is for a purchase of fill in the blank address, Wynwood, Pennsylvania, and no repayment is expected. And then it can be transferred at settlement. It can be transferred to you beforehand. We just have to document it.
Okay, got it. So let's say that I'm here, I've moved here, I'm in temporary housing, something like that. I'm ready to start looking for a home and I want to move pretty quickly because I'm sick of living in an apartment. So how long should I expect the pre-approval process to take?
An hour. We understand things move quickly, especially in our market, right? You'll be able to talk with buyers about just what's going on and the need for preparation and being ready for when the right house comes up. Our process, our initial pre-approval form and intake is 100% digital and can be completed online in 15, 20 minutes, after which we'll follow up and flesh out more details and get you ready to go. But you can be pre-approved same day, especially if you're a W-2 employee somewhere, as opposed to a business owner, where there's a little more underwriting, but that can still be done the same day. And keep in mind, it doesn't have to be all digital. If it's an accessibility concern, if it's someone who is not comfortable online, 100%, we can take an application over the phone. We can meet somebody in person, take it face to face too. We will certainly work with what's best for you. But in terms of expediency, the online application is really quick and easy and really same day within a matter of an hour.
Okay. And I've heard some things about this, so I'm not totally sure, but do I need to be worried about my credit taking a hit from getting a mortgage pre-approval?
Great question. And that's really something we talk about a lot. Credit bureaus give you a score, and that's an indicator of risk. The higher the score, the lower the risk, the easier it is to borrow. Having a mortgage lender look at your credit, and this is where people say, I don't want to have it pulled too often. The impact of having it pulled too often is that if you have multiple people looking at credit with the intention of extending credit to you, so multiple credit card issuers, multiple car companies, etc., that can be seen by the credit bureaus as an indicator of financial distress, and that will impact your score. Per the CFPB, and if anybody wants the link, I can send it to go to CFPB's website. Consumers are not really looking for multiple mortgages. And so having one lender, two lenders within a period of time check your credit is not going to have impact. It's going to be seen as one check, because it's not like you're trying to take out, like I said, 3 mortgages to help pay for it. And actually, one of the things that we've done in consultation with our buyers and seeing what's going on here is we're working off of a soft credit check right now. So that gives us the information we need, and it gives us scores and usage and history, but it doesn't impact one's credit at all. Period, end of sentence. And we've done that so people can really find out more information. And sometimes things take longer to buy a house, right? Very often it's, I found something, I want to get an offer, it's in, it's done, it's quick. But sometimes people need something particular and it takes a while to come up. So rather than take a hard credit check that expires, we'll take a soft one. And then when you're ready to make an offer, that's when we'll do the hard check just once. And it'll be good for 120 days. But the initial check, not going to have any impact on you whatsoever.
So, Dave, let's say that I was on Zillow or Redfin last night and I saw like the perfect house, and it had a pool and it had a 2-car garage, and it was like everything that I was looking for, but I haven't gotten a lender yet. I haven't gotten a pre-approval. So I go on to Rocket Mortgage or something similar, and I type in my numbers to get a pre-approval, and now I have one. And I go under contract on this lovely house with a pool. And then I think, oh, what if this isn't the best lender for me and I should see what else is out there? In this situation, how long do I have to really shop around and talk to different lenders, some of whom I guess might be taking either a soft pull or a hard pull on my credit?
Yeah, so the CFPB guidance says 45 days. You have that long of a window, which having another mortgage lender check your credit after the original one would not have an impact on you.
Okay. So 45 days is actually a really good period of time. That's fairly long. Okay. And what if I'm moving to the Philadelphia area from California or New York or another state, and I don't know whether I want to live on the main line or somewhere else in the Philly suburbs, or if I want to move to the New Jersey side of Philadelphia. And for people who aren't familiar with the area, there are some Philadelphia suburbs that are actually in New Jersey, and you can get into the city fairly easily from there. So sometimes people look in both areas. Now, do I need to get a pre-approval in both areas, or does that look like I'm potentially buying more than one house because they're in 2 different states?
Yeah, it's a really common scenario, right? Where the main line or the western suburbs of Philadelphia and the near-in communities of New Jersey are really the eastern suburbs of Philadelphia. It's just geography. And we work with plenty of buyers who are looking in both places, and we work off of one file. We're licensed in both states. And so if you tell me I need a quote for something in Narberth and I need a quote for something in Haddonfield, we work off of the same file, same credit, same everything to really simplify it for you. And we can switch back and forth until you find the right place, working off of your one original file.
Okay. So now that I have an offer accepted on a house, which is around here kind of a big deal, because sometimes, as you said, it can take a while to to find the house and then have your offer accepted. How long will it take for my mortgage to be approved so that I can go to closing and move into this house?
So we'll tell you and we'll tell Siobhan, we'll do whatever it takes for you to get the house and get the deal. Legally, it has to be, you should know this, it's 7 or 10 days, their disclosure requirements. It can't be shorter than that if you're getting financing, and that would be pretty difficult. But we've done as quick as 2.5 weeks if that's really what it takes and everybody pulls together to help. Our part is easy, and our pre-approval will help you get us the documentation we need up front to make it simple. I would say probably an average is about 35 days for transactions here, but trending a little shorter. We're seeing that pretty commonly. So if you put 3.5, 4 weeks, 100% will be done easy. You'll be ready to go.
Okay. And let's say that I'm worried about the current interest rates because who isn't? It's been a wild ride. So what options do I have for getting my rate lower?
We have a couple options, and rates are rates. And we always tell people, you're coming here and it's great and you're here, and let's get you into the house now because life is happening and that's the most important. And find something that you can afford now. Down the road, first of all, at settlement, we can look at a permanent buy down where you would pay extra interest at closing to get a lower rate. We'll talk to you about our market rate, and then we'll talk to you about what you could buy it down to, and we'll have that conversation. What's more important, a lower out-of-pocket figure at closing or a lower monthly? There is no right answer other than the one that is right for you. It is 100% subjective. Second, we could look at some sellers are offering temporary buy downs where you may save more per month, but it's for a lot less time. And that's something we can look at where for the first year or maybe 2, you'll have a lower payment. The sellers will effectively buy down your rate and save you money there. Another thing we can look at making a bit of a comeback are ARMs. So 30-year loans, ARM is an acronym for adjustable rate mortgage, where you have a lower rate fixed for the first 5, 7, or 10 years with the risk of adjustment at the end of that period. So depending upon your timing and your tolerance for risk, we can look at that. And then no matter what, ARM, fixed, permanent buy down, temporary buy down, when rates get to a place where you will benefit from a refinance, we'll reach out to you and say, now's the time to start the conversation. Let's look at where you are currently. Let's look at where we could get you now and do some math and find the right time, if this is going to be a long-term home for you, to get you into something that'll really give you the greatest benefit long-term.
Awesome. Okay. Couple more questions. Since I'm moving from across the country, do I need to be there in person to close on the house with a mortgage?
Another great question. Answer, depends. Depends on the loan product you are in. We offer RON, remote online notarization. It's allowed here in Pennsylvania and in Montgomery County, where the main line is primarily.
Right. Okay.
What that is rather than being here physically for closing, you can meet with a notary from the comfort of your computer. You may be across the country, you may be around the world, and sign all your closing documents in a face-to-face online meeting and get that done. That is going to be dependent upon the loan product you're in, and the title company has to be signed up to utilize our platform. But we've been doing it a lot lately, and it's been pretty popular for a number of years, since late 2019. And most of our local title companies have signed up and completed that. So it can certainly accommodate that. But there are a number of loan products that don't allow it, and we can talk about that up front. But if that's something that you really think you would like to have that option, let us know. We'll make sure you're in a loan product that would allow that.
So we live in an area here where a lot of people go on vacation during the summer. So some of them will go, to the Jersey Shore, but a lot of people here may travel to Europe or to Canada or India, China. So if I'm going to be just out of the country for a month, but I need to close on this house, is getting a power of attorney something that I might do?
That's a definite way to accommodate you wanting to have a representative here in person when you can't be here. And yeah, I don't know of many loan products that wouldn't allow that. And with an understanding that you cannot physically be here and going through the list of eligible signers on your behalf, people to whom you may grant power of attorney.
Mm-hmm.
Yep. We can do that as well if you can't be here.
So, final question. I know neither one of us has a crystal ball, but are you able to give us an opinion on where you think interest rates, which we talk about all the time, all day long, where do you think they might go in the near future and then in 2024?
Well, isn't that a great question?
I saved the best one for last.
Yeah, thank you. I'm ready. Just recently, we're starting to see some signs that maybe economy and inflation are cooling just a bit.
Mm-hmm.
Nothing conclusive enough to say, here's definitely what's happening. But we've been waiting. The Fed has been raising its interest rate, and other lenders have followed in suit because inflation was high and the economy was hot. They wanted to cool it down to something more manageable. So now we're starting to see that, again, in fits and starts. Not necessarily enough to say it's conclusively happening, but couple weeks in a row now, we're seeing some things that may indicate something's out there. So we've gained some ground recently. Could it be second quarter, third quarter, 24, we start to rally? I wouldn't find that impossible. I think that is a reasonable chance. Do rates go back to 4? No, but we get you a lot better and a lot happier and save you a lot of money on your payments. I think we'll start to see a little bit of that starting to break out sooner rather than later.
All right. I'm on board with that answer. For people who want to get in touch with you, Dave, what's the best way to do that?
Yeah, thank you. David.frankel@rate.com. So David.Frankel @ RATE singular.com. Best place to get me. And I'll be happy to talk, answer questions, and see what we could do to help you move to the main line.
All right. This was awesome. Thank you so much for all of this really helpful information. As a buyer who's moving to the main line, I feel like I now know what I need to know. But for anyone out there who still has lingering questions, they can contact me, contact you. And if you're watching this on YouTube, please hit that subscribe button because there will be more interviews with really helpful, informative people like Dave coming up. So thanks for being here. I really appreciate it.
My pleasure. Thank you.
All right. Talk to you soon.
Bye-bye.
Bye.